Well, y'all, November 11th, 2024. Thank y'all so much for joining us this morning, Monday Morning Touch Point. As you know, we're going to be updating the new listing to pending ratio, the single best leading market indicator available for the entire area. And we're going to hit it hard this morning because I also want to go over a lot of stats with you all to show you what's happening in the market. We're going to look at the economic calendar, see what's happening for the rest of the week. Of course, today is Veterans Day, so the market is closed. No bond market activity today, but we will do a recap for the previous week to show you how crazy and wild the previous week was with the bond market. But we're going to go ahead and start by updating the new listing to pending ratio. As you know, we're going to go a little bit backwards in time. We're going to update the pending for the previous week. We're going to change this 369 number to 379. Let's go ahead and update the previous week. That's going to go from the 21st to the 28th, and that's going to take us to 403. Let's keep on going from the 14th to the 21st. That's going to take us to 424, 424. Let's update the previous week from the 7th all the way to the 14th. That's going to go to 466. We no longer have to update anything. 2 weeks ago, we ended the week at a 0.80 ratio. Not bad. Now, the previous week, the week before that, from October 21st all the way through October 28th, an amazing 0.93 ratio because we had a huge drop in the number of new listings entering the market. So 0.93, very bullish, very strong, dipped down a little bit down to the 0.80. As we continue to update the pendings, I can expect this to go up to the 0.81, 0.82 range when we keep on updating this, but 0.80, not bad. Really encouraging going into November, December timeframe with a 0.80. I will take this all day long. Last week of last month, we were at a 0.82. That's where we're going to end, is right around the 0.80, 0.82. Want to remind you that these ratios right here, it's only for our 6-county area. We're taking the new listings, the back on the market, we're dividing it by the active under contract and the pending. So this is going to be for our specific area. Now, the mortgage rate is going to be the average mortgage rate for the nation going back a week. We have to choose one consistent data point when we're looking at mortgage rate, and that's going to be the Freddie Mac 30-year mortgage rate. That's what we're going to use. This is what we're talking about. If you go to teamprice.com, you go to Insight and Statistics, the first link, the very first link is going to be the 30-year fixed mortgage rate. And that's going to be what we use. This is taken on a weekly basis. This is the Freddie Mac Primary Mortgage Market Survey. Every Thursday at 11 a.m., they release these figures. And they've been releasing this going all the way back to 1971. Every Thursday, 11 a.m., they release it. We update this page. And this is the rate that we use for all of our calculations. Affordability, buying versus renting, everything is based on this rate. So keep that in mind. It is a lagging rate, meaning if rates are going down really fast, this is going to appear a little bit higher. If rates are going up really fast, this is going to appear a little bit lower, which is the case right here. We all know that 2 weeks ago, rates were not 6.54. 2 weeks ago, they were closer to 6.75. But we have to look at a consistent figure. That's what we have to do. Now, one question is, well, how does this compare with the local figures? Well, the good thing is that the local figures we receive 3 times a week, Mondays, Wednesdays, and Fridays. And right now we're roughly at the 6.875 range. But once again, this right here is the average rate that's released on Thursday for the previous week. So how does it compare? Sometimes it can be a little bit higher. Sometimes it can be a little bit lower. For example, let's just say that rates real time plummet. Let's say that on Friday, the demand for mortgage-backed securities is now super high. Prices go up, therefore yields go down, and then rates drop down to the 6.25. Well, then our local rates are going to be lower than this national figure, which is the average for the previous week. And then the opposite is true, which is what we've been encountering. But the whole point is that we have to pick one number that we choose all the time. Another question, with treasuries up 5 basis points over the last week and the corporate bond market has decreased almost 60 basis points, do you think this is the market? Do you think the market is digesting in a positive way the election results? Now, we're going to go over the bond market. We're going to take a look at what's happening with the bond market. So we'll definitely take a look at that, look at the economic calendar. We will do a pretty good overview of how did the bond market digest the election results and all that. So we will definitely touch base on that. So we've updated all the previous week. Let's go ahead and start updating this week. This week is going to go from the 4th to the 11th. We're going to take a look at new listings, and that's going to give us right at exactly 700. 700 new listings so far. Keep in mind, new price increase, price drop back on the market. Active under contract will lock today at 11:59. So when you get this updated resource tomorrow morning, all of these figures will be locked. And of course, pending, we will keep on updating this over the next few weeks. Let's take a look at price increase. Price increase, we're going to be right at 135, a drop from 250 past week. Now, we know that builders towards the last week of the month, first week of the month, they love to increase the prices. We saw that here. We saw that here. We saw that here. They love to increase prices. 85% of these 250 price increases were builders. And then they kind of start going down a little bit. So we're looking at 135 price increases over the past 7 days. Not bad. Not a bad number of price increases. So let's take a look at how many price drops. Let's see what's going on with how many price drops. Let me go ahead and just pull up this figure. We are looking at a total of 1,311 price drops. 1311. A pretty big difference compared to the previous week at 1,096. So we went from 1,096 price drops to 1,311. A pretty big week over week increase on price drops. I would say the reason why we had this big pause on price drops, it goes back to the election. Well, let's just kind of wait. Before we do a price drop, let's just wait. Everyone waited last week. They waited even 2 weeks ago. They waited to put their homes on the market. Then we saw a little bit of a bump, 781. But price drops 1,096 up to 1,311. We're back to the 91 percentile. So out of everything that went up on price versus everything that went down on price, 91% went down on price. Let's take a look at back on the market. Back on the market, we are currently at 163 back on the market. 163, 23%, little bit higher than the previous week at 22%. So now let's take a look at active under contract. Active under contract, we are at 357. 357 back on the market, a little bit lower than the previous week. This is going to be updated between now and 11:59. Now, this is where you get to guess, you all. What do you think? How many pendings? Last week, 379. What do you think? How many pendings? Let's go ahead and get 5 guesses going. 5 guesses. How many pendings? Okay, Melanie coming in at 265. 265. Okay, good stuff. Good stuff. Let's keep on going. Okay, we've got 265, 300, 275, 290, 283. All right, you all, let's take a look how many pendings we are at. 200. Ooh, Sonia, you came in very close. You're off by one. 224. 224 pendings. That's going to give us a 0.67 ratio going into Monday. What does that mean a week from now? Right around that 0.80. When we revisit this number a week from now, we're going to be back at that 0.80, 0.81, 0.82. That's good. I agree with you, Melanie. That is good. I am very encouraged post-election to see a 0.67 ratio going into the middle of November into December. Now, statistically, we do have good Decembers in our market. 93% of Decembers are better than Octobers. So really good. Melanie said, I had 8 groups in my open house yesterday. I'm telling you all, now that there's clarity with what's going on with election, I mean, of course, you saw the stock market absolutely killing it. Bitcoin, y'all, it's going to hit $250,000. I said this, you can look at the recording. I said this 3 years ago, that Bitcoin's going to hit $250,000. And in my professional opinion, I'm not telling you to buy anything. The only financial advice that I ever give everyone is to buy forever stamps. Guaranteed never to lose money. That's the only financial advice I ever give people. Forever stamps. Guaranteed you will never lose money on forever stamps. Outside of that, you can do whatever you want. But we're looking at a rally across the equity market. We're looking at a rally across crypto. I sure hope that we end up in a place where the dollar is pegged to some sort of a crypto type currency that we can't just print, or that crypto is, the dollar is tagged to a combination of gold and crypto. Wouldn't that be amazing? That would be really neat. That would be fantastic. Let us take a look at the monthly. We're going to update now the monthly information. First thing we're going to do is go a little bit backwards in time. We are going to look at last month, October, 1618. 1618. The ratio for last month at exactly 0.77. Let us see what's going on with the ratio so far this month. We're going to take a look at new listings. New listings for this month of October 2024. New listings so far this month, 989 new listings. A little bit on the low side of things. I mean, we're almost halfway through the month and only 989. Okay, that's fine. 296 price increase. How many price drops? 1540 price drops. 84%, way better than last month. Take a look at that. 84% so far this month, a dramatic drop. Best ratio that we've seen going all the way back to March. Last November, we had a 90% ratio. We are at 84% right now. Back on the market, let's take a look at this. 214 back on the market. That's going to give us a 22% ratio. That is the highest ratio going all the way back to July. Let's take a look at active under contract. We are at 473. 473. And how many pending? 331. So we're at a 0.67 ratio. Last month, 0.77. If this activity continues, we did have a good 2 weeks ago when you look at the week over week, but keep in mind when we look at the weekly, what I do is I overlap weekends. This is going to give us a really good consistent reading on weekend activity, which is very important for real estate. So I do overlap you see this ends the 4th, this starts the 4th. There is a little bit of an overlap there, which is needed. It's fine. I've been using the ratio this way for a decade. It works. On the monthly, it's beginning of the month, end of the month. So that gives you a really good sense of the activity the entire month. So we're at a 0.67. Where are we going to end? Are we going to beat 0.82? No, we're not. I'd say we're going to end right around that 0.75 to 0.78 ratio, in line with October, which was not a bad October. Now look at December of last year, 1.08. which was the highest reading that we had going all the way back to 2022. Are we going to get anywhere close to that 1.08? Now, the only reason we had a 1.08 ratio December 2023 is that everyone just put a pause on putting their homes on the market. And then they came out with an absolute flood of activity come February, March. I foresee something very similar happening this year. We're going to see a pullback on the number of new listings coming on the market this December going into January, and then a flood of new listings hitting the market February, March. If you have a seller contemplating putting their home on the market, earlier the better. I would aim for first 10 days of February. We have a very early selling cycle in the Austin area. We are not the summer selling season. We are not the May through July selling market. We used to have a peak market in May, and that's shrinking. We are now looking at a peak market from March into April. I have sellers that will prefer January to February. Would you recommend against that? Well, I wouldn't say recommending against that. If you can push that to the second week of January, you're going to be fine. Not a big deal at all. I just wouldn't go the first week of January. I would just pull back until, January 10th into the 15th. Not a big deal. You're going to be totally fine. Be one of the first really good, amazing listings that hit the market. Price right, looks good, smells good, feels good, tastes good. All of that, you're going to be fine. Let's take a look at how many closed properties. We are looking at 712 closed properties. That's a low number. Wow, so far for the month of November, that's really low. Let's take a look at how many withdrawn so far. 263. Well, good news is that that's low also. And how many expired? We are looking at 136 expired. There you have it. Let's take a look at the month-over-month comparison. Now, take a look at, let's do the year-over-year comparison. Let's kind of scroll down a little bit. I just want you to focus on October. Let's take a look at the year-over-year comparison for the month of October. As you know, all of this is going to be printed as a PDF, and we will be able to review everything. As a matter of fact, let me do this. Let me go ahead and just print this out as a PDF so that we can review the entire PDF. Let me get you the team price screen so that you can at least stare at something while you wait for me to print this as a PDF so that we can review all this awesome, amazing, fantastic data. Y'all, I'm in such a good mood today. I am in such a good mood today. Okay, we are publishing. It's going to open up here in the next few seconds. There we have it. So let's take a look at all this amazing information. There's the weekly, week over week. So far, we are down 68 new listings. We are down 98 price increases. We are down 300 price drops. Down 300 price drops. Way more price drops last year compared to this year. This is the weekly year-over-year comparison. We are also down on pending, but here's the encouraging thing. Going all the way back to September, we've been up on active under contract. We've been up on pending from September, first week of September, all the way down to the first week of October. We went negative a little bit on the pending, still positive on the active under contract. So when you add active under contract and pending, we've been positive going all the way back to the end of August. So far, properties are going under contract at an accelerated rate this year compared to last year when you look from August all the way through the beginning of November. Now, we had a brutal summer. Take a look at the summer, June, all the way through August, big negative numbers. But all of that reversed itself, and it is slowing down a little bit. We did have our peak in September. September was a darn good month. Why is that? Rates. That's when rates hit that peak bottom. And because rates that went up, number of properties that went under contract pulled back a little bit. So far this week, we're down 29.2, but we know not to trust that number quite yet because a lot of properties are going to go pending over the next 24 hours and then over the next 7 days. Of course, we updated the monthly, so let's take a look at the month-over-month comparison. Well, we're only 11 days into the month, so we're going to go ahead and skip this. Let's take a look at the year-over-year comparison. We spoke about October. October, really nice positive month. We had 6.8% more properties go pending October 2024 compared to October 2023. 11.6% more pending September, all about rates. We are now down 71%, and it is the 11th of the month, so we're not going to be positive. We're going to be negative. We're not going to see a positive number. We're going to have more properties that have gone under contract November 2023 compared to November 2024 because rates went up a little bit. So we all know the impact that rates have when we are looking at properties that go under contract. New listing to pending ratio so far this month is at a 0.67. November of last year, 0.82. November of 2022, 0.85. Let's take a look at active per 100,000 people. We are statistically like exactly the average for all of November going all the way back to 2005. 0.0 above average. Isn't that amazing? Active per, so this is almost like that perfect market equilibrium. If you were to take every single November and look at the average for every single November, we are at exactly the historical per 100,000 population average. We are up 9% year over year, but historical average. The cumulative new listings from January to November, we are 13.7% above average. Cumulative, everything that's come on the market from January all the way through today, we're looking at 43,685. That is a 4.7% year over year increase. Back on the market, 21.6%, slightly lower than last year. Cumulative pending from January through November, we are 2.7% above average without indexing it to population. The next chart that I'm going to show you, we're going to index it to population. In the cumulative pending per 100,000 people from January through November, we're still low. And because it says cumulative, we've had a good October. We had a good September. But when you add everything, we had a really difficult May through September. So we had a lot of negative numbers that were building up and stacking up. But when you look at the cumulative, when you add everything, we are down 6.9% compared to last year when you adjust it based on population. 1,555 pending per 100,000 people. Let's take a look at cumulative withdrawn plus expired. Everything that has withdrawn plus expired from January to today, we're at 12,363. 6.9% increase compared to last year. Cumulative sold. 27,127 properties have sold in the entire 6-county area from January through November of this year. Year to date. That is a 5.8% drop from last year. When we adjust this for population, cumulative sold January through November, per 100,000 people, we are down 8.1%. We're at 1,079. Good news is that we beat 2010. But a lot of this has to do with the pullback in activity that we noticed from the end of March all the way through September. September was a decent month. So we had a really good October. When are those properties closing? Well, they're closing in November. And so far, we're having a really decent November. First 11 days, pretty decent. When are those properties going to close? Into December. So I do expect this number to go up at an accelerated rate because we had a decent October, a decent September, a good October, really good October. I'd say decent August, good September, good October, looking like a good November. This number's going to go up. Are we going to beat 2011? Yes, we are. I'm just going to call it out right there. I'm going to be very bullish and say, we're going to beat 2011. We already beat 2010. Are we going to beat 2009? I'd say we're going to be in between 2011, 2009. When we review all of this information, when the year totally closes out, I'd say we're going to be in between 2009, 2011, which is a really good progress. When you look at when we were reviewing this data, we were crazy low. We were lower than 2010. That goes to show how good of a August, September, and October we've had on the number of properties that went pending. For the entire year, we're at a 0.77 ratio, which is also encouraging because at one point we were lower than 2011, which was 0.76. Where are we going to land? 0.80-ish is where we're going to land the ratio for the entire year. So that puts us in a market where inventory continues to go up. Number of active listings are down because of the seasonality of real estate. People pull their homes off the market. You saw the number of withdrawn and expired listings that we've had. That's really high. That's why the number of active listings is going down. But we are seeing people bringing listings on the market, and I do expect a surge on the number of new listings coming on the market January into February. It'll peak in April. A lot of the new listings that'll come on the market in April, unless it's perfect, the perfect listing, which you and I both know that half of them are not going to be perfect. They're going to be overpriced. They're not going to look good. Seller, listing agent, whoever, they're going to take shortcuts and they're not going to go anywhere. But we are going to see a lot of listings come on the market, in my professional opinion. Let's take a look at how many active listings are currently in the market. 13,810 active listings. That is down 4.96% month over month, up 12.4% year over year. 3,960 pending listings, up. This is really encouraging, 7.6% year over year. That's going to give us an activity index of 22.3%. Pending divided by active plus pending. That's going to be the activity index, 22.3%. Under 5 months of inventory, 4.9. When you look at the activity index, 30.18% new construction, 18.46% resale. We continue to see new construction just tearing it up. Really good activity on new construction. 44.2% of all the pending listings right now are new construction. Amazing. 44.2%. Even though new construction only accounts for 29.3% of the active inventory. We continue to see an increase in short sale. We're hitting 33 short sale properties right now across the entire MLS. Let's take a look at pending listings. We can see that we've been positive on pending going all the way back to the first week of October. We've had more pendings this year compared to last year. This is really encouraging that we continue to see this. Real estate owned is down. You're absolutely right. Real estate owned properties are absolutely down. That is a very good point. Activity index currently at 22.3%. This time last year, we were at 23%. We bottomed out November 5th last year at 22.79. This year, we bottomed out towards the end of August, and now we've slowly and gradually going up on the activity index, which is really encouraging. You can see what's been going on with inventory. We reached a record high inventory of 15,503 listings July 15th. It was a Monday. We are down 1,693 active listings. We are currently at 13,810. Out of those 13,810 active listings, 54.3% of those have had a price decrease. Let's take a look at activity index for cities, and we're going to do a really brief activity index for zip codes, take a look at affordability, and I want to see improvement in activity index. What's going up? What's going down? Little bit of a pullback in the city of Austin. We were at 20.1% in October. We're at 19.6% right now. Keep in mind, activity index pending divided by active plus pending. It is a leading market indicator. Buda, we hit a low. That is a 12-month low on Buda at 23.2%. Burnett, we hit a low at 13%. Driftwood, we hit a low, but look at the improvement in Dripping Springs from 15.4 up to 23.7. Georgetown, a massive improvement from 23.2 to 28. It's a decent size improvement. Let's take a look at the rest here. For the most part, we're not seeing a ton of record low activity index. For the most part, we are noticing some improvement in the activity index. From Pflugerville to Round Rock. Round Rock, we hit a low August of 23.5. We're at 29.3. So activity is picking up in some areas. Other areas, Wimberley down to 9%. That's going to be a 12-month low within that area. When you look at activity index and you look at months of inventory per price range, this is really, really telling when you look at the activity index per price point. Some areas, really low inventory, decent activity index, really nice. Other areas, not so much. Take a look at Georgetown. Where are price points moving? Between 300 to 400, 33% activity index, 2.6 months of inventory. And then you go to the 800 to 900, you're looking at 7 months of inventory. I can't wait to see zip code. Let's take a look at zip code and see the price point per zip code. You all, over $1 million in downtown Austin, 52.5 months of inventory. Over $1 million in downtown Austin. Absolutely amazing. Absolutely amazing. Take a look at 78721, 8% activity index, 33 months of inventory. And then you've got some other areas. Look at 78726, only 0.8 months of inventory. So some areas are doing extremely well. The 800 to 900 and 78717, that's going to be the Avery Ranch area. Unbelievably hot, multiple offers, limited choices for your clients, only 0.8 months of inventory. Super hot market with a 67% activity index. This is going to be the activity index zip code. Take a look at this. With rates going up and with pricing going up, what do you think happens with affordability? Well, affordability goes down. And we can see that the PITI, principal, interest, taxes, insurance, using the median sold price this month was 20% down, and the 30-year mortgage rate for this month shot up to $3,405, up from $3,208. That's going to be an increase of $197. Added to the increase of the previous month of $92. That's a really big increase. As a percentage, that is a 6.1% increase. And that's going to be the largest month-over-month payment increase going all the way back to April of 2022, because prices have shot up over the past 2 months. So much so that the average sold price so far this month is $591,964. That is a 5.1% month-over-month increase and a staggering 10.1% year-over-year increase. You and I both know that this is going to pull back. More expensive properties sell the first 2 weeks of the month. Cheaper homes sell the last 2 weeks of the month. That's the way it always is. It'll always work out this way. I start consolidating the median sold, the average sold towards after the 7th of the month. So today is the 11th, so we're going to start looking at this figure. But what this tells me, we're going to be positive. We were positive last month. Last month, October, the median sold price increased month over month by $49.90. The average sold price increased by $12,821. So with this amazing increase in pricing, look at that, 10.1%. That's the largest number we've seen since 2022. We are down from the peak 13.19%. When you look at the average sold price, when you look at the median sold price, we are down 19.09%. When you look at the median sold price compared to 24 months prior, we are down 3.26%. But look at that line going up, straight up. So we've had an improvement over the past 2 months. Really good October, looking like a really, really good November. We're also going to have a really good December, which means that when you are comping your listing come January and February, be very cautious. You don't want to take a look at this amazing activity that we saw September, October, November. And if you don't take interest rates into account, you could very well overprice your property because it's all about monthly payment. So if rates go back down under that 6.5%, then you're fine. Use that comp. But if rates hold at the 6.875%, it's not that you have to ignore that record high price that closed in November on a property that went under contract in September. You have to take that into consideration. You've got to do a competitive analysis. If other properties that are priced like that are not selling, then you've got to be assertive on your pricing and you've got to take interest rates into account, especially if it's a interest rate sensitive area, meaning most of the properties are going conventional, FHA, VA. If you're in an area that has a high cash purchase percentage, and you can pull all this data on the MLS, it's really easy to pull this data. I can show you. If you're in an area that has over 35% cash transactions, you're not going to be a interest rate sensitive area. If you're in an area and you're about to list your property and you've got a 10% cash purchase ratio, that's an interest rate sensitive area, and you've got to take that into account. The median sold price versus 36 months prior, we are down 5.12%. So what about the entire MLS? We're at 5 months of inventory when you look at the entire MLS. To be exact, we're at 4.97 months of inventory. And we are now officially back in a seller's market. We've been in a neutral market and we're back into a seller's market. More so because of the number of withdrawns and expireds. That took a lot of listings off the market. So we're not seeing a record high number of sold properties. We're just seeing a lot of properties being taken off the market. And that's something that we have to be aware of. So what happened with sales? Last month, for the month of October, 2,366 properties sold. Better than September at 2,295. but still lower than August. Some of this seasonality of real estate. So we really have to compare year over year. Year over year, almost exactly the same. Last year, 2,367. This year, October, 2,366. And there's always a few stragglers when it comes to real estate agents updating their sold listings. So we're going to have a better October compared to last year. But you can see that we're not having like 10% higher number of properties that sold. So we're not noticing an explosion of sold properties, just a little bit better than last year. That confirms that the reason why inventory is going down, months of inventory, is not because we're seeing a dramatic increase in demand. It's a drop on the number of active listings. And when you look at the number of expireds and withdrawns, that accounts for the difference. That accounts for the drop in inventory, months of inventory. When you look at sales density, we were up 3.1% month over month last month. So far, the expectation is that we're going to be down 10.5%. Year over year, we were statistically the same last month. We're looking at a positive year over year, which when you look at the year over year, November tends to be a positive month. 17 out of the past 24 years, we had a year-over-year improvement for the month of November. December, same thing, 17. Cumulative sold. And you see, this is exactly what we were talking about. Cumulative sold properties, January through November, we're down 1.5. We're going to make that up. We're going to be statistically the same. When we crank out the data, January, February of next year, and we look at everything that's sold this year, we're going to be statistically the same. That's what's going to happen. Let's look at a few more. Here we've got cumulative sold per 100,000 population. We're at 1,122. We're going to end the year just about the same. Last year we had 1,168. Good improvement over the past few days. Very good improvement over the past, I'd say few months. Going into August, September, October, more pendings equals more sold. Still single-digit percentage increases on the sold, not double-digit increases. But that means that as we close out those deals that went under contract September, October, this number is going to improve a little bit. Now, what about the number of agents in the entire Austin area MLS? We're at 18,689 agents. So far, that is a drop of 12.16%. With the drop on the number of agents and the slight increase on the number of pendings, little bit of an increase on the number of sold, what about sold per 1,000 realtors? The forecast for this month is 113.3. That's going to be better than last year, better than 2 years ago, way better. Last month, 127.7, better than last year, better than 2 years ago. So we are noticing an improvement on the number of sold properties. Agents that stuck around, hey, this is my career, this is it, I'm doing this, they are going to reap the benefits of a market that is improving. And we can see what happened last time around. We had way negative numbers. Best year ever for realtors. Best month ever for realtors, July 2013. And that's because the number of agents kept on going down. As sales were improving, the agents that were left reaped the spoils of war. And we can see the sold per 1,000 realtors for the month of November. There's that 4% increase from a 2.6% increase. So it is really, really encouraging and really nice just to see this going up, an improvement year over year. Now, I'll say this, I could not be more proud of you, Team Price agents, because our number as a company is not 4%. It's closer to 20% with very similar agent count. So I'm super, super proud of you all. A lot of team price agents are having amazing, amazing years, and the data just shows that. So I'm very, very proud of you all. Super, super grateful. Let's take a look at sold to list price ratio. This number continues to experience a pullback. The sold to list price ratio, when you look at the final sold price to the final list price and you compare that, 96.96%. Last month, 97.05. So we are looking at a month-to-month drop, and we're also looking at a year-over-year drop because last year we were at 97.15. So buyers are able to negotiate more right now, more in this market, even though rates went down, up a little bit in November, but rates were down. Take a look at the number of properties that sold over list price. We're at 10%. Sold over list price. Last month, 10.5. The month before that, 11.5. Sold over list price. We're back down to that 10% figure. November 2023, it was 12.2%. Let's take a look at type of market. Out of the top 30 cities that we track, 40% are in a seller's market. 12 out of 30, seller's market. 10 out of 30, 33% in a neutral market. 8 out of 30 in a buyer's market. And when you look at zip code, 29 out of 75 in a seller's market. That's 39%. 22 out of 75, 29% in a neutral market. And 24, it's a large number, 24 in a buyer's market. Let's take a look at the zip codes that are very close to switching markets. We have 78726 at 6.67 months of inventory. 7 months puts us into a buyer's market. There's not enough room right there to call this into a buyer's market. It's almost like we're running like a election thing. Like, am I going to call that yet? No, we just have to wait a little bit and see more data. Well, let's take a look at how many are going into same thing on this side of things. This is too big of a gap to say that these are going to move into a neutral market over the next week or so. We just have to wait and see. There's a big gap right there from 4.56 crossing into 5. Might not seem like it, but that's a big gap. So not enough. We have to wait a few more days, a few more weeks to be able to call whether or not these are going to experience a pullback. I'll even say this. Manor, 78733 Austin, 78751 Austin. I would say that with people holding back on listing their homes, with properties closing, and with an increase in withdrawals and expireds, I'm going to go reverse. I'm going to say that these zip codes are actually going to fall back into a seller's market. They're going to fall back into a seller's market. We're going to see an increase in zip codes that are in a seller's market because of withdrawals and expireds. That's what we're going to notice. And let's take a look, you all, at a few more things right here. We're going to go back on the market, and let's see here. Let's take a look at a few more things for you all. Type of market. Let's take a look at this one. Months of inventory and median days on the market. We're noticing a really high median days on the market. Really high. I mean, we're approaching 80 median days on the market when you look at all the top 30 cities that we track. So that is increasing. Keep that in mind. We are noticing properties stay in the market a little bit longer than something that we've been used to over the past even 10 years. Let's take a look at the economic calendar and let's see what's going to happen this week with the economic calendar today. Nothing going on today. Today is Veterans Day, so we're not going to have any reports today. Same thing with the bond market. We saw the bond market last week. This is the election. Yields skyrocketed right after the election. We met Wednesday morning, and what did I tell you Wednesday morning? I said, hey, just hold up on it. It's just going, this is an overcorrection. It's going to go back down. And that's exactly what happened. It went back down and we finished the week exactly how we started the week. And that's even with the Fed announcing a rate cut and all that. So this is good news. This is, and everyone knew there was going to be a pullback. So it's not like we saw rates at 7.5% because of that. Not a big deal at all. We knew there was going to be a pullback. So let's see what's going on. I do have one question. Could you explain what months of inventory means? Yeah, absolutely. As a matter of fact, when you scroll all the way down on our website and you go to Real Estate Glossary, we do have a section that specifically talks about months of inventory. But bottom line, the way that there are a few different ways to calculate months of inventory. And I use different methods of calculation for different charts, but it all yields a very similar result. When I'm looking at months of inventory for this resource right here, months of inventory right here, what I'm doing is I'm taking a look at the previous 90 days, and I'm simply saying, based on what's happened over the past 90 days in the active inventory that we have, how much inventory, if nothing new came on the market, how long would it take to deplete the existing inventory that we have? So you take a look at the city of Austin. Based on the activity over the past 90 days, it would take 5.15 months to deplete the number of active listings that we currently have on the market. Now, months of inventory will fall under three categories. Is it a buyer's market, a neutral market, or a seller's market? A seller's market is defined as less than 147 months of inventory. Not months, days. Days. Less than 147 days of inventory is going to be a seller's market. And that's going to be 4.9 months. A neutral market is going to be between 150 and 207 days of inventory. Buyer's market, more than 210 days of inventory. Now, let me go to market update. And I just actually closed that. So I'm going to have to open that up again. And that's going to be market update. There we have it. This right here, in order to maintain consistency with the way that I calculate the data, I calculate months of inventory on this resource just a little bit different. What I do is I take a look at everything that's sold that month, and then I have an average for the year. So, okay, so what's the going rate per month as an average compared to everything? And the reason I do it that way for this chart is that it's a consistent way to do it going all the way back 20 years. Because doing it on the average per month is going to give you just a really nice flow and a nice view of the market on average. Because you have more properties that sell in June than you do in December. So what happens if I don't use it for this long-term calculation is that you're going to have really fast peaks and then crashes on months of inventory. You're going to see, wow, 6.5 months of inventory in August. And then it's going to kind of crash back down. So I like to see the average for the entire year. But it's the same thing. You take how many active divided by how many sold per month. So there are a lot of different ways to calculate. Some companies calculate months of inventory on what sold that month last year. That is my least favorite way to calculate it. I would rather either take the previous 3 months or the average for the year. The reason I don't like to calculate using what sold last year is because of this. Look at this. Look what happened from 2020 to 2021. We had a massive drop on the number of sold properties. Every company that was calculating months of inventory using what happened last year, what do they have? An artificially low months of inventory. So they're like, oh, I don't know what y'all talking about, the market shifting. We're looking at 3 months of inventory. And I'm like, heck no, we're not. We're looking at, 4.5 months of inventory because I'm using recent data. This was the struggle that we had with the Austin Board of Realtors data. Some of you all into 2022, 2023, y'all were like, Dan, I don't know what you're talking about the market. You're saying that inventory is at 4.5 months. The board has it at 2.5 months. And I'm like, oh yeah, that's because they're using last year's data. We're not in last year's market anymore. We're in this year's market. And the recent data shows us that inventory is increasing because demand is dropping, activity is dropping. We've got less properties that are selling. So we're going to use the past 90 days. That's why I like to use current data and not last year's data. But there are a lot of different ways to calculate it. My main thing is this: consistency in how you calculate the data, because then you can identify trends, you can address trends. So on this one right here, let me go back to the one that I just closed. On this one, I use the average for the month for the entire year. Everything that's sold January through year to date, what's the average per month? And then on the type of market, I just go back 90 days. So hopefully that answers your question. Let me know if that answers your question. Let's take a look at the economic calendar. What's going on with the economic calendar? We've got tomorrow, small business optimism. We've got some bond auctions. Loan officer survey. I do like looking at the loan officer survey. I will read that. Wednesday, we've got mortgage applications. Let's get rid of this ad. Big one, CPI. What does that stand for, you all? Consumer Price Index. Inflation. Is inflation going to come in a little bit hotter than expected? What's going to happen with inflation, real earnings? Going into Thursday, we've got PPI. PPI is the Producer Price Index. That's the input cost as opposed to the consumption cost, which is CPI. And then going into Friday, we've got export pricing, retail sales, industrial production, capacity utilization. So this is a big week. This is an important week when it comes to rates. If CPI, PPI comes in hotter than expected, then you can expect what? Well, you can expect a pullback within the bond market, which means that prices go down and yields go up. So I'm going to give you my prediction right now. I would say that we've got some lagging data when it comes to owner's rent equivalent that is going to contribute to a better than expected CPI. So I expect CPI to be a little bit better than forecast. And maybe I'm just hoping that that's the case so we can see an improvement in the mortgage-backed security price and therefore an improvement on the yield. But I do see enough data right now that would point to a better than expected CPI along with hopefully a better than expected PPI. Of course, owner's rent equivalent has absolutely nothing to do with PPI, but I'm hoping for a better than expected PPI. But we're just going to have to wait and see. We are having our mentorship meeting tomorrow at 10 a.m. live in person. Be sure to join us. And then we have our Wednesday meeting and training. We're going to go over the contract review, and we're going to go over some additional contract information for y'all Wednesday. We do not have a meeting on Friday. We do not have a meeting Friday. Keep in mind, we do not have a meeting on Friday. Now, let's go back to the original question that was posed with Treasuries up 5 basis points over the last week and corporate bond market decreased almost 60 basis points. Do you think that the market is digesting in a positive way the election results? Well, no doubt the equity market is. No doubt about that. And by the way, you all, if they do pass the no tax on tips, then we're going to change all of our commission disbursement authorizations, and it's going to be a 3% tip instead of a 3% commission. Do you think we get away with that? Just out of curiosity, it's like, hey, I didn't get paid a commission. I got paid a 3% tip. Like, what are you talking about? So I'm thinking about just changing everything to tips. That's at least what I'm thinking about doing. I don't know. You can tell I'm a realtor, right? It's just kind of like you're reading like, okay, how can we make the absolute best of it? I didn't get a paid a commission. I work on tips. I just work on tips. So that would be amazing. Wouldn't that be like the coolest thing in the world? Another rule that I not a rule, but a proposal that I read, and I don't know, maybe this is like fake news or something, but I liked it when I read it, so I hope it's true. But it's temporarily, until things improve, to cap all credit card interest at 10%. Y'all, if that is true, and if they're able to do that, for me, like, done. Like, do that like yesterday. Do that now. That would be absolutely, like, in my opinion, amazing. Because when you look at rates right now, and this only goes back to August, I mean, you're looking at an average of like 23%. And in my opinion, that's criminal. Like, that's like mafia. Like, that's ridiculous. Especially when a good number of people, they're using their credit cards not to go to Vegas. They're using it to buy groceries, right? So I don't know where I read it. So proposal to cap revolving rate at 10%. I'll have to find it somewhere. Okay, so Wall Street Journal, long shot proposal for 10% cap on credit card, cap it at 10%. Yeah, so there's a bunch of articles right there. Temporary cap on 10%. So, I personally, I'm kind of down for that. I think it's 25% that some of these companies are doing it because people kind of have to use it. I'd be for that. It's like, hey, you know what? You guys are making just like, it's ridiculous. Hey, let's just temporarily, let's just do, hey, if you can forgive student loans, you can cap credit card at 10%, right? That's my deal. Just cap it at 10%. So I'd be for that personally. I think that'd be a good thing. Maybe do like a 2 years. And maybe it could even be a deal where if you sign up for it, then your credit line is locked. It's like, hey, you know what? We're not going to let you keep on going into debt, but we're going to lock in your credit card at 10%. Like, I think that would be a good idea personally. It's like, we're going to lock if you sign up for this, we're going to lock it at 10%, but we're also going to lock your credit line. You're not going to be able to just keep on maxing out at 10%. Like, we want there to be a path of you getting out of this nonsense. So I would be absolutely for that. 25% on a credit card, that's mafia tactic in my opinion. That's just absolutely criminal in my opinion. So yeah, there's a ton of articles here, and y'all pick your poison, right? So you can read an article that says that, this is the worst decision in the world, and you can read an article that says this is the best decision in the world. Pick your poison. Which is why I am a fan of ground news. And no, I do not get paid to advertise ground news, although I probably should. But it's a really good because it shows you how biased the article is. And it gives you like a bias reading. And then you can purposefully pick articles that reinforce your bias. Or you can pick articles that are actually against your bias. It's like, well, maybe I'm wrong. Maybe there's an article out there with information that would actually give me better context. So I like ground news personally. I've been using it for many, many years. It's a really good app because sometimes I'm like fixated on one thing. I'm like, well, let me just read what else people are saying. And then it also gives you articles that are just neutral. It's like, hey, there's no bias to this. This is just an economic article. And just here you go. This is an economic article. So it is what it is. Okay, wonder if we'd see stories about people getting way into debt due to lower interest rates than going crazy with spending. Yeah, that could, and that's where I say, right, maybe like freeze, hey, anything that you currently have, we're going to freeze it. But, Yeah, I'm sure that there's stuff that they can do around it. But once again, right, if you're able to kind of wipe away a bunch of student debt, then why can't you do this? I think it's a good idea. Good stuff, you all. But yeah, clearly the equity market is digesting the election and in a positive way. You just can't, I mean, the data speaks for itself when it comes to the equity market, but we're just going to have to wait and see and play out, see what's going on with that. Have you read the Housing Wire article regarding tariff increasing pricing on new homes? Haven't read that yet. Send me the link. Love reading stuff like that. So until I read it, I can't have an opinion on it without having read it. So yeah, send me the link and love to be able to read it, digest it, see exactly what they're talking about. So yeah, please, definitely send it my way. I'd love to be able to read that. Super appreciate it. Reminder, you all, we do not have a meeting on Friday. I will be in the beautiful state of Michigan. We'll be in Ann Arbor, Michigan. But we do have next Monday a Monday morning touch point. So we do have a Monday morning touch point next Monday, even though I arrive at 1:40 a.m. That is when the plane lands. So unless there's a delay in the flight and I have to spend the night in Chicago or something or Detroit, sure hope that's not the case because I want to make it here by the Monday morning touch point. We do not have a meeting Friday. We do have a meeting on Monday. Well, you all, it is 11:10. I want to honor your time. We had a really good crowd here today. Super appreciate you taking the time to join us for our Monday morning touch point. I will keep you posted on what's happening with the bond market throughout the week, especially with this week being such an important week for the bond market. CPI, PPI, a lot of bond auctions, small business optimism, lots and lots going on. So please join us for our mentorship meeting tomorrow. That's going to be great. Join us for our Wednesday training. I emailed you a contract review earlier today. Take a look at the contract review. Always be better and proficient on writing contracts. For those who did the contract proficiency last week, way to go. That's going to benefit you. That's going to benefit your clients. And this week's contract proficiency is going to be super simple, a triplex. So take a stab at it. Probably never sold a triplex in your life. Take a stab at it. Triplex. So if there are no questions, comments, concerns, criticisms, or complaints, thank you so very much for joining. Super appreciate it. And okay, we do have a question. What's the best way to find out the most desirable rental option for a given property? Long-term rental, furnished or unfurnished, or Airbnb? That's a very good question. You're always going to have to rely on data, in my personal opinion, when it comes to the best way to find the most desirable rental option. So it's very hard to find furnished. You're going to have to use a remarks search. A lot of agents do not update that little field on whether it's furnished or unfurnished. So you're going to have to do the wild card search under remarks. So when you scroll down on Matrix, let's go to internet remarks here. Let's find, okay, so here we got private remarks, and then we've got, let's take a look at private remarks also. In wildcard, furnish, wildcard. So you've got 287 that show furnished as a wildcard. And then do they have a furnished feature here? Let's take a look to see if they have furnished here. It might be under additional fields. Furnished. Yes. So if you select furnished here and you say furnished, you've got 234. So clearly there are some properties that are furnished that do not show up as furnished if you select furnished. So you're going to have to use both of those. What I found in the area is that short-term rental, not short-term as an Airbnb, but someone that has a house that's getting built and they're 3 to 6 months out and they just need a place, or someone moving to the Austin area really quickly, they need a place furnished, they've got a house that they're building. You're going to be able to get quite a bit on the rental side for the furnished, but it's a very narrow market. Austin is not known as like your corporate housing type city where you can do 12-month furnished places. We tend to see furnished as a negative as opposed to a positive, unless you can find that very limited, very narrow client that happens to need that place at the time. As far as Airbnb, give Lucas a call. Lucas is absolutely amazing. CHL Property Management. He offices here out of the office. He's a really close relationship with Team Price. Team Price is actually the the sponsoring broker for his property management company, but he is the property manager. He manages everything. And you will not find a better Airbnb property manager in the entire Texas area. He is the absolute best, especially if he's going to be managing that Airbnb, which I'm a huge fan of actually hiring a professional Airbnb manager that has the crew to be able to turn over the place and comp the place and, pitch that project for him. It's like, hey, what do you think about this property? And he will draft a amazing proposal for the property. And he knows the Airbnb market so extremely well that he's not going to take something that's not going to generate a amazing rate of return for the client. So if he looks at it, he knows that market better than anyone I've ever met in my life. He's going to be able to say, no, there's no way. Like, there's no market for this. So you can also go to Airbnb and look at properties that are currently on Airbnb. The biggest thing on Airbnb, it's does that neighborhood allow it? Are you able to Airbnb that specific property? But rely on data. Be 100% obsessed with data. Do the wildcard search. Filter down to what has been leasing. That is furnished. What was the length of the lease? Because the mistake that you don't want to make, and I know that you wouldn't make this mistake, but let's talk about it. The mistake that you don't want to make is take that furnished lease that was for 3 months, and it shows that it leased for $4,000, and it's like, oh wow, $4,000, but it was a 3-month lease. A 12-month lease unfurnished would be $2,300, but they just happen to find that perfect tenant for that short-term lease. So keep that in mind. I do want to address one last question that was posed a while back. Let me scroll up on this really quick and address this one question right here. This was really early into the meeting, so let me scroll up to make sure that I am able to. I have a question for San Marcos listing agents. Do you list on ABOR and CTX MLS, or do you join SABOR? Sonia responded, I don't list on SABOR. I could not agree more with that. Absolutely. If you do have a listing in San Marcos, just forget SABOR. Don't do SABOR. But ABOR and CTX MLS is an absolute must. Don't even worry about SABOR. If you are way south of San Marcos, do another 20, 30 miles between San Marcos and San Antonio, whatever exists between San Marcos and San Antonio. But if you are in between there, you're going to have to consider SABOR. In that case, do all three. But if it's strictly San Marcos, completely skip SABOR. Don't even worry about SABOR. Very good question. All right, y'all. Any more questions, comments, concerns, criticisms, or complaints? Okay, we've got another one. What would be the best resource to use to help a client decide how long to expect to hold to a rental property before selling? Is that a cash flow analysis? So let's clarify the question a little bit. Excellent question, but I wanted some clarity. How long to expect to hold to a rental property before selling? Meaning they're upside down right now and they want to not be upside down, so they've got to rent it now. So how long do they have to wait until they're going to be able to rent it for profit? Is that a part of the question? Or like, what's the motivation? So go for it.
It purchased and is looking at the opportunity, but trying to figure out what's the and that was for me. I felt it was kind of vague. So the long term of what have we been seeing is the average timing or how long you would expect to hold on to this rental property if you bought one today
Okay.
before it made sense to sell.
Well, I would
advantage.
say the longer that you hold on to it, the less sense it makes to sell unless you can deploy that capital to a better asset. And the reason I say that is I really like this break even analysis. This is one of my favorite tools that we offer. And let's just say that you buy a property for $300,000, $75,000 down payment. So there's your down payment right there, 25%. And you got a 7.5% rate, and you can get $2,100 for rent. And that area is experiencing a 2.5% rent appreciation. We can, and by the way, this inflation number comes straight for the historical inflation. I've got like a CPI chart that goes all the way back to 1990, and it gives me like the average CPI going all the way back to 1990. So I'm not making this up. This is like, all right, well, the average inflation is 2.7. It is what it is. You've got your property insurance, you've got your property taxes. Let's say the property has an HOA. So you've got your operating expense. So what I've done here is I have your rental income, your mortgage, your operating expense, and your yearly profit. So for this situation, you're not going to break even until year 33. That's when you're going to break even, year 33. But you're going to start generating a profit on year 22. So for this client, he might be like, well, I can't wait 22 years to start generating a profit. Well, so then don't lease it. I mean, like, and that's where I go back to like, well, what's the goal? But if they're like, oh, okay, I'm fine with this, and let's just tweak the numbers. Let's just say that they paid $225,000. They got a really good deal. And well, now they start generating a profit on year 7. Their break even is on year 12. Right, which means they've recouped all of their losses, they've broken even, and now they're just making an obscene amount of money. So in this case, then, well, keep on holding on to it, because every year that you hold on to it, you're adding a significant amount of cumulative profit, because every year you're generating profit. So that's what I would rely on if the goal is strictly like, well, how long should I hold on to it? Well, use this. But my point is always, if you can deploy that capital to a higher rate of return, well, then we have to analyze that investment every year and say, well, your cap rate, your rate of return on this property is 3.5%. Here's another property that's going to give you 5.5%. It makes sense to sell that now, 1031 exchange any gains into another property that's going to yield a better rate of return. So I would say that decision at the very least ought to be evaluated on an ongoing basis, right? On a yearly basis. Is this the best use of capital deployment, or can I deploy this capital to a higher rate of return? And if the client looks at that asset and they say, well, no, this is a very good rate of return. I've got low vacancy. I've got high rents. Rents are appreciating at a 3.5%, 4.5%, 5% annual appreciation. I'm going to hold firm. This is it. This is a good investment. I'm increasing my profit. I'm increasing my cumulative profit. This is it. So I would say it's a decision that they ought to make across all of their investments on an ongoing basis. Where we can partner with a client is we can do that touch point. And one of the things that I've done for my clients, which is why we created under Market Update this in-depth analysis for investors and home buyers, is the investment insight and the landlord's rental analysis, where I love sending these to my investor clients saying, hey, let's sit down, let's look at all of your properties. Let's do like that 30-minute analysis across all of your properties, and let's see if the best use of your capital is to maintain this property, or maybe we can 1031 exchange the gains. Let's do an analysis on each one of your properties. Now, if the client is asking that question because they're like, I can't sell it because prices have gone down, I have to rent it. When does it make sense for me to sell it to where I can actually gain a profit on this property, or at least break even? The resource that I'm going to rely on is going to be this market cycle and the return to peak value chart that we have. And it's going to be this one right here. So what I'm going to do is I'm going to take a look at what we can sell the property for right now. I'm going to look at the compound appreciation for that zip code. The compound appreciation for all of Austin going back 25 years is 5.145%. Each zip code is going to have a compound appreciation, and you can get that on appreciation zip code. And I like to use the median price for that. So if you keep on scrolling down, you're going to see the median price. So let's say that that property is located, I'm just going to pick something, and 78741 Leander. Well, the compound appreciation in 78641 going back 25 years is 6.5%. So I'm going to tell the client, if today is the bottom of the market, let's add 6.5% compound and see when does it make sense for us to actually sell this asset. So if the property now is worth 300, I'm going to do 300 times 6.5% equals, and then that amount times 6.5% equals, and then that amount times 6.5% equals, and say, hey, your return to profit is 5 years, 3 years. So rent it right now. You might take a hit on cash flow, but we are making some pretty big assumptions. Number one is we're assuming that today is the bottom of the market. And I would say if the market corrects any further, we're 90% there. We've experienced 90% of the correction that we're going to experience. So we're darn close. But you can forecast a return to profit by using the compound appreciation going back 25 years. So whether we're answering one question or the other question, we've got the tools and we've got the data to help the client answer both questions. And oftentimes the client doesn't even know what question they're trying to answer. They're just processing all their options, which is great. That's what we're here for, is just to process all the options with the client. So does that help?
Immensely. Thank you.
Good stuff. Absolutely. And we do have a contact right there.
Yeah, for the comments that you were saying about San Antonio, may very, lately we have clients there, but when we do and we go find the properties and we don't have access to open those log boxes, I put a contact of a gentleman that I've used before, another agent, and call him with time and he'll make the time.
Oh, love it.
I mean,
Love
I
it.
paid $50 last year. I don't know what he charges now, but it's worth it.
Oh, that's huge. That's worth it. So there you go, you all. There's the contact. Thank you so much for sharing. Super, super appreciate it. Well, you all, thank you all so very much for joining. Super appreciate it. Have an absolutely amazing rest of your day. Be on the lookout for this summary from me, and I will chat with you all later. Join us tomorrow for our Tuesday mentorship meeting live in person here at the office. Wednesday training, no meeting on Friday. Have a great rest of your week, and I will chat with you later.